I'll tell you this story in my own words because it keeps getting reduced to headlines and numbers and memes, when it's really about something much bigger, something that's taken decades of risk and obsession and belief. When people talk about my compensation at Tesla, they often miss the point that I never took a salary, never asked for cash bonuses, never set this up as a guaranteed payout. I designed it as an impossible-looking challenge tied entirely to performance, because I wanted my incentives to be brutally aligned with shareholders, employees, and the mission. The plan was simple. In concept and insane in execution, Tesla would have to grow in value, revenue, and operational execution to levels most people said were delusional. And only if we hit those milestones would I earn anything. At the time, Tesla was fighting for survival. Short sellers were everywhere. Analysts were calling us a niche automaker at best. Bankruptcy was a real word in internal conversations, so when people now look backward and say the numbers are too big, they forget how small and fragile everything was when the plan was created. The idea of Tesla even approaching $1 trillion valuation sounded like science fiction, but that's the point. You don't transform the world by aiming low. You aim for something that forces you to rethink physics, manufacturing, software, energy, and scale all at once. The compensation structure was designed to push me to build not just a car company, but a vertically integrated AI, robotics, and energy platform disguised as an automaker. And as Tesla grew, as the stock reflected that growth, analysts began reframing the compensation plan not as pay, but as a market catalyst, because it signaled confidence, long-term vision, and an almost reckless commitment to execution. Every tranche was tied to Tesla becoming fundamentally more valuable, not just in market cap but in real operational metrics. Vehicles produced, factories built, margins improved, software deployed, autonomy progressed, energy storage scaled, and when the stock moved, it wasn't because of a press release about my pay. It was because investors were reassessing what Tesla actually is. Is it just a car company, or is it the backbone of a future where transportation, energy, and intelligence converge? The $1 trillion conversation didn't come from hype alone. It came from the realization that if Tesla solves autonomy, manufacturing efficiency, and AI at scale, the addressable market explodes beyond anything traditional valuation models can easily capture. And yes, my compensation becomes enormous in that scenario, but only because the pie itself has become enormous. Shareholders win first, employees win through equity, customers win through better products, and the world wins through accelerated sustainability. The controversy, the lawsuits, the debates about fairness, those are all part of operating at the edge of what's ever been attempted. When analysts say my compensation could be a catalyst, what they really mean is that it forces the market to confront the long-term thesis again. It makes people ask whether Tesla's best days are behind it or still ahead, whether autonomy, robotics, and AI are real value drivers or just optionality, and whether leadership that thinks in decades rather than quarters should be incentivized differently. I've always believed that if you're going to ask people to do the impossible, you have to tie rewards to outcomes that actually matter, not optics, not comfort, not tradition. And if Tesla never reaches those heights, then I get nothing, and that's fair. But if it does, then it means we've built something that fundamentally changed the trajectory of multiple industries. And that's a story worth telling. Not as a payday, but as proof that betting everything on the future can sometimes pull that future forward faster than anyone expects. Because when people see Tesla's stock react to compensation headlines, they think it's emotional or irrational. But markets are really just collective belief systems adjusting in real time. Belief about leadership, belief about execution, belief about whether the future arrives faster or slower. And my role in that is less about money and more about signal. The signal that I'm still all in, still sleeping on factory floors, still obsessing over production lines, still pushing teams to shave milliseconds off neural network inference and pennies off battery costs. Because Tesla's next phase isn't incremental, it's exponential. Autonomy isn't just a feature, it's a platform. When a car can drive itself safely at scale, it stops being a depreciating asset and starts becoming a revenue-generating node in a network. And that changes everything about valuation, about margins, about utilization, about how many vehicles the world actually needs. And the same logic applies to Optimus, to energy storage, to AI training infrastructure. People laugh at humanoid robots until they understand labor economics, until they realize that a scalable, general-purpose robot rewrites GDP math. And when analysts bake those possibilities into models, even conservatively, suddenly the trillion-dollar discussion doesn't sound crazy. It sounds delayed, and my compensation becomes a proxy for whether the market believes I can execute on those visions again. Not once, but repeatedly. Because doing it once is luck. Doing it over and over is systems thinking. The stock doesn't just move on earnings, it moves on conviction. Conviction that Tesla can manufacture faster than competitors can copy. That software updates can unlock value after delivery. That vertical integration isn't inefficiency, but leverage. And every time the compensation plan is debated, it forces that conviction into the open. It makes investors choose whether they believe this company is capped by traditional auto multiples or liberated by technology multiples. And I've always argued that Tesla isn't valued correctly if you ignore autonomy, energy, and AI. It's like valuing Amazon as a bookstore or Apple as a computer manufacturer. The early critics weren't stupid. They were anchored, and anchoring is fatal when the world is changing fast. The lawsuits and governance debates are part of the process of redefining how founders are incentivized to take existential risks. Because no one would rationally attempt what we're attempting for a normal CEO package, the stress, the scrutiny, the constant threat of failure. It only makes sense if the upside is tied to outcomes that reshape industries. And if Tesla does reach or surpass $1 trillion valuation sustainably, it won't be because of financial engineering or hype cycles. It'll be because millions of small engineering wins compounded over years finally became impossible to ignore. At that point, the compensation number will look big only in isolation, not relative to the value created, and that's the core of this entire discussion. Value creation versus value extraction. I've always been on the side of creating as much value as possible first and letting the rewards be a downstream effect, because if Tesla succeeds at the level we're aiming for, the stock performance won't just reflect a company doing well. It'll reflect a shift in how humanity moves, powers itself, and eventually works alongside machines. And that's why this topic keeps trending. Not because people care about my paycheck, but because they're trying to decide whether they believe that future is actually coming and whether Tesla is still the company pulling it into existence. Because the hardest thing for markets to price isn't growth, it's persistence. Can you keep executing when the narrative flips, when competition crowds in, when margins compress, when regulators push back, when the easy wins are gone? That's the phase Tesla is in now. And that's why the compensation discussion matters more today than it did when everything was going up and to the right. Because now the question is whether I'm still the right person to drive the next S-curve. And I don't answer that with words, I answer it with factories, with code, with hardware that ships, with systems that learn. The plan was always structured so that I only win if Tesla wins in a measurable, undeniable way. Not vibes, not promises, not interviews, real metrics that compound over time. And when people say the compensation is too large, they're really saying they're uncomfortable with asymmetric outcomes, but innovation has always been asymmetric. A few breakthroughs carry disproportionate value: the assembly line, the microchip, the internet, AI, and Tesla sits at the intersection of several of those curves at once. Manufacturing, energy, autonomy, robotics, and that's not easy to steward. It requires making decisions that look wrong before they look obvious. It requires tolerating volatility, including in the stock, because progress is lumpy, not smooth. The market wants predictability, but breakthroughs arrive in bursts, and when they do, they reprice everything retroactively. That's why analysts keep calling this compensation plan a catalyst, because it's a forcing function. It says either Tesla executes at a historic level or I walk away with nothing. There's no middle ground, and that binary nature makes people pay attention. It sharpens the debate about whether this company is still early in its journey or already mature. And I've always believed we're closer to the beginning than the end. Autonomy isn't solved yet. Energy storage isn't scaled enough yet. Optimus is barely out of the lab. AI training is accelerating faster than most people realize. And when those pieces lock together, the value creation won't be linear. It'll be step change. The stock will eventually reflect that, not because of sentiment, but because cash flows, margins, and optionality will force the issue. And if that happens, the compensation won't feel like excess, it'll feel like a footnote.